Everyone has an opinion about Realty Income. Some say it's the safest REIT on the planet, others say it's dead money. So here's the real question: who's right? Today we'll look at the data and settle this debate once and for all. Realty Income got its start in 1969 with a single investment in a Taco Bell. Today, the retail REIT owns thousands of properties across America, leased to hundreds of tenants operating in dozens of industries. Retail properties account for most of the firm's rental revenue, with industrial warehouses and gaming venues generating almost all of the remainder. All properties are under long-term, triple net lease agreements, which shift property operating expenses to tenants and generate predictable cash flow to fund monthly dividend payments. The company is currently available with a 5.72% starting dividend yield compared to its 5-year average of 5.04%. The price-to-AFFO ratio is now 13, while the 5-year average was 14.9, and the sector average is around 14.8. The stock is trading at about $56, whereas the expected price is estimated to be between $58 and $71. Based on these metrics, the company appears to be slightly undervalued. The company currently pays $3.24 in dividends per year, distributed monthly in 12 installments. The next dividend payment will be on December 15th, and anyone who holds shares by November 28th at the latest will be eligible to receive it. The most recent dividend increase was 2.9%. The average increase over the past 5 years is also 2.9%, while the 10-year average was 3.6%. The FFO payout ratio is well below the healthy 90% threshold and has been showing a strong downward trend. FFO per share, on the other hand, is on a steady upward trajectory. The growth isn't very fast, but it is stable, and the company even managed to grow during COVID and continued to perform well in today's high interest rate environment. The company issues new shares every year, which is completely normal for REITs. These issuances typically fund expansions, renovations, and dividend payments. As long as the total sales chart grows at least as fast as the shares outstanding chart, this does not pose a problem, and that condition is being met here. The company did take on a bit more debt than ideal during COVID, but management took this seriously and began reducing leverage. Based on expectations, the company could once again fall below the 5.5 leverage target within the next 12 months. Meanwhile, the interest coverage chart has remained comfortably above the 2-point threshold for the past 10 years. In short, the company is currently available with a nearly 6% starting dividend yield, with the most recent dividend increase around 3%. It holds an A- credit rating, and the dividend appears to be safe. Based on the overall fundamentals, the company may be slightly undervalued and could be an attractive entry point for more conservative dividend investors. The fact that it pays dividends monthly is an additional bonus. When you look at Realty Income's latest quarter, the first thing that stands out is how consistent the company continues to be. Even in a higher rate environment, they deployed $1.4 billion in new investments, including $1 billion in Europe at an 8% yield, while U.S. investments came in at a 7% yield. Sourced volume has already reached $97 billion year to date, surpassing last year's record. Operationally, the quarter was extremely strong. Occupancy reached 98.7%, and the 103.5% rent recapture rate across 284 released properties shows that not only are tenants staying, but renewed leases are being signed at even stronger economics. Financial flexibility remains solid as well. Realty Income ended Q3 with 5.4 times net debt to EBITDA and a 4.6 times fixed charge coverage ratio. After the quarter ended, they added approximately $1 billion in unsettled forward equity and issued $800 million in unsecured notes at a 4.4% yield, further strengthening their liquidity position. Management reaffirmed their AFFO per share guidance of $4.25 to $4.27 and raised their investment volume outlook to $5.5 billion for 2025. This increase signals confidence in sourcing attractive opportunities despite a challenging environment. Looking beyond the quarter, Realty Income's long-term portfolio stability continues to differentiate the company. Their occupancy levels have held around 98% plus for decades, including during recessions and shocks, far above the median REIT. Credit losses remain exceptionally low, averaging just 0.4% between 2014 and 2024. This reflects high-quality tenants, disciplined underwriting, and strong asset management across a massive global portfolio. Europe continues to be a major growth driver. Since 2019, Realty Income has invested nearly $15 billion across 8 countries, with an average remaining lease term of approximately 8.3 years and strong rental economics. Management believes Europe offers a larger total addressable market than the US, supported by lower competition and more favorable debt costs. Across the entire portfolio, Realty Income's global diversification by tenant, geography, property type, and industry remains one of its greatest strengths. These slides demonstrate how size, scale, and geographic breadth contribute to unparalleled cash flow durability. Realty Income's predictability remains unmatched. High occupancy, strong recapture, minimal bad debt, and continued global expansion, including Europe. The balance sheet is also robust, supported by strong credit metrics. The main challenge is the higher cost of capital, which tightens acquisition spreads. Only 4% of sourced volume has been acquired in 2025 year to date, highlighting tougher deal economics. General and administrative costs are slightly elevated, and 5.4 times leverage, while safe, is on the higher side of Realty Income's historical range. This quarter reinforced everything Realty Income is known for: stability, disciplined growth, and strong global diversification. With high occupancy, reliable cash flows, and steady AFFO performance, the company remains one of the most dependable income-producing REITs. Despite headwinds from interest rates, Realty Income's long-term fundamentals, scale, conservative underwriting, and mission-critical real estate remain firmly intact. What if you could earn a steady 6% dividend by owning a piece of some of America's most iconic hotels and casinos without ever making a reservation? Could one stock really turn that dream into reality? Before diving into the numbers, it's important to understand what VICI actually is. VICI is not a traditional landlord and not a typical REIT either. It owns mission-critical experiential real estate, casinos, resorts, entertainment venues, and leases them out under long-term triple net leases. This means tenants pay rent, maintenance, insurance, and taxes, while VICI focuses on collecting highly predictable cash flows. Since its formation in 2017, the company has announced roughly $38 billion in investments, building one of the largest gaming and experiential real estate portfolios in the world. The company is currently available with a starting dividend yield above 6%, compared to its 5-year average of around 5%. The price-to-FFO ratio stands at 11.8 versus the 5-year average of 14.4 and the sector average of roughly 15. The stock is trading at $28.66, while analysts estimate a target range between $31 and $38. Based on these metrics, VICI appears to be slightly undervalued. VICI currently pays $1.80 in dividends per year, distributed quarterly. The next dividend payment will be on January 8th, and anyone who holds shares by December 17th at the latest will be eligible to receive it. The most recent dividend increase was 4%, while the 5-year average increase is 7.7%. The company has been paying and raising dividends for the past 6 years. The FFO payout ratio hovers around the 75% target year after year. Both FFO and free cash flow per share are on an upward trend, characterized by slow but steady growth. The company issues new shares every year, which is completely normal in the REIT sector. And as long as the growth in the total sales chart keeps pace, this does not pose a problem. The company's debt level is higher than ideal, likely due to increased leverage during COVID, but it has been decreasing since then, despite the high interest rate environment, which is good news, as management takes debt control seriously. The interest coverage chart has remained above the 3-point target over recent years and appears to be stabilizing again. In short, the company is currently available with a 6.28% starting dividend, which was recently increased by 4%. It holds a BBB- credit rating, and the dividend appears to be safe for now. However, the company needs to monitor its debt levels carefully and continue repayments or grow revenue faster than debt. This could be an attractive entry point for slightly more risk-tolerant investors who value a high dividend yield. If interest rates are cut, the company could benefit, and this would likely be reflected in the stock price.
Disclaimer. This video is for informational and educational purposes only. It does not constitute financial advice. Always do your own research before making any investment decisions, and never base a financial decision solely on the content of this video.
VICI's growth story is one of disciplined scaling. Since inception, adjusted EBITDA has grown nearly 4 times, reaching an annualized $3.3 billion in Q3 2025. This didn't come from reckless expansion, but from carefully structured acquisitions, tenant diversification, and balance sheet discipline. The company also achieved investment-grade ratings and joined the S&P 500 remarkably fast for a REIT, a strong signal of institutional credibility. One of the most impressive parts of the quarter is how protected the cash flows are. VICI reported 100% occupancy, 100% triple net leases, and 90% of rent backed by parent guarantees. The weighted average lease term is about 40 years, which is almost unheard of in real estate. On top of that, 79% of rent comes from SEC reporting tenants, meaning investors can actually see the financial health of the operators behind the rent payments. This quarter again highlighted why VICI performs differently from traditional net lease REITs. Around 42% of rent is CPI linked today, and that figure climbs to 90% over the long term. In a world where inflation can suddenly reappear, this is a built-in hedge. Even better, VICI runs with extremely low overhead. G&A is just 1.6% of revenue, one of the lowest in the entire sector. The business is lean, scalable, and inflation-aware by design. Yes, gaming is still the backbone, but the portfolio has quietly evolved. VICI now owns 54 gaming properties and 39 other experiential assets across the US and Canada. It is also the largest owner of hotel rooms and privately owned convention space in America. Las Vegas remains central, with trophy assets on the Strip and exposure to mega events like Formula One, the Super Bowl ecosystem, and future MLB development. These are assets that are practically impossible to replicate today. Management made it clear that future growth will come from 3 engines. 1. Acquiring irreplaceable experiential real estate. 2. Providing structured financing with embedded ownership options. And 3. Partnering with tenants to fund expansions in exchange for higher rent. This quarter reinforced that VICI doesn't just buy buildings, it positions itself upstream, often securing call options or ROFRs that could turn today's loans into tomorrow's owned assets. That creates a visible long-term growth pipeline without betting the balance sheet. Since IPO, VICI has delivered a 124% total return, significantly outperforming the REIT index. Dividend investors should pay attention. VICI has raised its dividend every single year since inception, now paying $1.8 annually, with an approximately 6% yield and a targeted 75% AFFO payout ratio. Dividend growth has compounded at 6.6% annually, which is exceptional for a REIT at this size. The balance sheet remains solid. Net leverage sits around 5.0 times, right within management's target range. About 99% of debt is fixed rate, 83% is unsecured, and the weighted average maturity is over 6 years. With investment-grade ratings from all 3 agencies, VICI retains flexibility even if capital markets tighten again. Key positives: extremely long lease terms with inflation-linked rent escalators, 100% occupancy and rent collection even historically through crises, consistent dividend growth with a high starting yield, investment-grade balance sheet with mostly fixed-rate debt, unique, irreplaceable real estate with high barriers to entry. Key negatives: heavy exposure to the gaming and leisure industry. Growth increasingly depends on structured deals rather than pure acquisitions. High valuation sensitivity to interest rates due to REIT structure. Concentration in large tenants like Caesars and MGM. Conclusion: this quarter didn't bring flashy surprises, and that's exactly the point. VICI continues to execute a boringly excellent strategy: protect cash flows, grow rent organically, and compound dividends over time. For long-term dividend and income investors, this report reinforces that VICI is less about short-term excitement and more about durable, inflation-resistant compounding. It's not a growth stock story. It's a cash machine story done right. What if I told you there's a dividend stock that's been paying investors for over 50 years and just raised its dividend again? Today, we're breaking down one of the most reliable income machines in the entire REIT sector, NNN REIT. Is it still a buy, or is the best already behind us? Let's find out. Incorporated in 1984, NNN is a real estate investment trust that owns over 3,000 freestanding retail properties across the United States. The company focuses on net leases, where tenants are responsible for property expenses like taxes, insurance, and maintenance, providing stable rental income for NNN. Its properties are leased to a diverse group of tenants in industries such as convenience stores, restaurants, and automotive services, with long-term leases that reduce turnover risk. The company is currently available with a 5.97% starting dividend yield, while the 5-year average was 5.13%. The price to FFO ratio is now 11.5, compared to the 5-year average of 13.4, and the sector average is around 14.8 at the moment. The company is already available for $40, while the expected price is estimated to be between $42 and $51. Based on these metrics, the company appears to be slightly undervalued. The company currently pays out $2.40 in dividends per year, distributed quarterly. The next dividend payment will be on February 17th, and anyone who holds shares by January 30th at the latest will be eligible to receive it. The most recent dividend increase was 3.4%. Over the past 5 years, they have raised the dividend by an average of 2.4%, and over the past 10 years by an average of 3.3%. This isn't the highest growth rate, but given the already high starting dividend yield, it is acceptable. Over the past 12 months, the FFO payout ratio was 69%, and the expectation for the next 12 months is the same. This is well below the commonly accepted 90% threshold, and it has consistently stayed below that level for the past 15 years. The adjusted FFO per share is not growing very quickly, but it is steadily increasing year after year. The same is true for free cash flow per share. This is clearly reflected in the FFO per share growth chart, with the only notable exception being during COVID, which is not surprising. The same pattern appears on the sales growth chart as well. As is typical for REITs, the company issues new shares every year to fund developments and dividend payments. As long as total sales continue to grow at least at the same pace, this will not pose a long-term problem, and in this case, that condition is being met. Debt management is something the company's leadership will need to pay more attention to going forward, because the company's debt has visibly increased due to COVID and the high interest rate environment. However, there is no major concern at this point, since the interest coverage ratio, despite trending downward, remains safely above the expected level of 2. To briefly summarize the points above, the company is available with a nearly 6% starting dividend yield, which was most recently increased by 3.4%. It holds a BBB plus credit rating, which is considered strong, and the dividend appears to be safe. Based on the fundamentals, the company may be slightly undervalued. It is most suitable for more conservative investors who are comfortable with slower but steady growth, with the added bonus of a high initial dividend yield. And now, we're diving into NNN REIT's latest investor presentation from November 2025. This company is one of the most stable net lease REITs in the U.S., and believe it or not, they've raised their dividend for 36 straight years. That's consistency you can really count on. So let's talk about what makes NNN tick and whether it still deserves a spot in your income portfolio. NNN just wrapped another steady quarter. Their core FFO per share grew 1.2% year over year to 85 cents, and AFFO per share was up 2.4% to 86 cents. Not huge leaps, but steady, reliable growth, exactly what keeps dividends safe in the long run. Annual base rent jumped 7.2% year over year, thanks to new acquisitions and strong occupancy. They closed $283 million in new investments this quarter, at a 7.3% cap rate, solid compared to the sector average. Year to date, they've invested $748 million, beating their guidance. At the same time, they sold 23 properties for $41.3 million. The interesting part? Some of these sold at a 5.9% cap rate, while new purchases are higher. That spread boosts long-term returns. They also raised $71.7 million in equity and issued $500 million in senior notes at 4.6%, giving them extra financial flexibility. And the dividend? 60 cents per share this quarter, up 3.4%, with a 70% AFO payout ratio. Very sustainable. The strategy here is simple, and that's actually what makes it strong. NNN focuses on single-tenant net lease properties, meaning the tenants cover taxes, insurance, and maintenance. That keeps operating risks super low. Leases run 10 to 20 years, with the current portfolio averaging 10.1 years remaining. Only 3.2% of leases expire through 2026, giving them remarkable cash flow visibility. And the numbers speak for themselves. Occupancy has never dipped below 96.4% in the past 20 years. And they pick prime Main Street locations, keeping rents strong and sustainable. Their portfolio is massive, 3,697 properties, 39.2 million square feet across all 50 states, with over 400 tenants in more than 35 industries. Top tenants run an average of 1,731 stores each, giving NNN incredible resilience and low earnings volatility, even in recessions. NNN's acquisition approach is disciplined. They don't just look at current tenants. They buy based on the quality of the location and potential future tenants. Lower rents make it easier for tenants to succeed, which drives higher renewal rates and long-term occupancy stability. Since 2010, NNN has acquired over $10.4 billion in properties. 72% through relationship deals at an average 7.4% cap rate, and 28% through market or auction deals at 7.1%. That gap between purchase yield and cost of capital is what fuels long-term FFO growth. The portfolio is well diversified across regions. No single area dominates. Southeast, 25.4%, Midwest, 24.4%, South, 24.4%, Northeast, 13.8%, Rocky Mountain, 7.6%, West, 4.4%. The top states by property count are Texas, Florida, and Ohio. This kind of geographic spread reduces economic and regional risks. Financially, NNN is rock solid. Their capital structure is 62% equity and 38% debt, very conservative for a REIT. The $4.95 billion of debt carries a 4.2% average interest rate, with 10.7 years average maturity. No floating rate or secured debt. Interest coverage sits at 4.1 times, and the maturities are nicely laddered out to 2052. In a high-rate environment, that's a huge advantage. Let's talk dividends. 36 consecutive years of increases. Their current annual dividend is $2.40 per share, yielding 5.6% as of September 2025, with a 70% AFO payout ratio. For anyone chasing reliable income, this REIT is built for you. Over the long haul, NNN consistently beats the REIT industry. 25-year annualized return of 12.3%, 20-year 9.6%, 15-year 8.7%. Sure, the S&P 500 has outperformed in the past decade, but for steady income compounding, NNN remains a top-tier performer. Strengths: what NNN does exceptionally well. Extremely stable income with long-term net leases, high occupancy over decades, minimal lease expirations. Safe, growing dividend for 36 years. Conservative balance sheet with long-term fixed debt. Disciplined acquisitions at attractive cap rates. Massive diversification across states and industries. Potential risks: slow FFO growth, mid-single digits. Retail-focused tenant base, somewhat sensitive to downturns. Large absolute debt despite good management. Stock price volatility. 1-year return of minus 7.1% despite strong fundamentals. So the conclusion is, NNN REIT is the ultimate sleep-well-at-night dividend investment. It doesn't aim for explosive growth, but it delivers decades of consistency, stable cash flow, industry-leading occupancy, and one of the longest dividend growth streaks in the REIT world. If your goal is long-term income, stability, and low volatility, NNN is a strong candidate. If you want fast growth or tech-style returns, it may feel slow. But for dividend investors, this REIT is one of the most reliable income machines you'll find today.
Thanks for watching, and if you found value in today's video, give it a thumbs up and consider subscribing for more smart, long-term investing ideas. Stay patient, stay consistent, and keep building your path to financial freedom. Until next time, take care and happy investing.